What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is June 22nd of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and it's that time again to finally review what's going on over at the Federal Reserve, or the Fed, as well as the broader world of central banks, and talk about where the roadmap is for the next coming months and what it's going to do to asset markets abroad. All right, so we've got a lot of things to discuss right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. If you're on the hunt for a proven, trustworthy exchange in Europe to trade your crypto, then I recommend taking a look at Bitpanda. If you're just getting started, many people refer to Bitpanda as the European Coinbase, so it can be a great place to start in getting your first crypto positions. With over 5 years of experience serving the industry by offering easy and secure access to digital currencies, Bitpanda has really earned its reputation. Check out the link down below in the description for more information. Alrighty, everyone, so let's go ahead and take a quick look across the board for cryptocurrency markets. To start, taking a look at the last 24 hours, the vast majority of cryptocurrencies are in a no trend scenario in the top 100. However, we have a few outliers. Swissborg leading the market up nearly 18%, Digibyte up nearly 17% after finally getting listed on Binance. I know that was a long-term request from those of you in the Digibyte community. You guys pressed hard, so you got it. And outside of that as well, Aave coming in at nearly 13%, continuing to rip higher. This thing is an absolute machine. Now, I wanted to share with you guys real quick. I'm going to be speaking at a free virtual conference. It's called Remote Crypto Con. They're giving away 500 VIP tickets, so check out the link down below in the description, and you can not only see a great range of virtual speakers, but people like myself as well who are going to be speaking there. So recommend you guys check that out. And one thing I want to go ahead and start off by as we jump into this topic of the Fed is obviously taking a quick look at Bitcoin here in the short term. I'm really liking what I'm seeing here on the daily here. If we take a look at the hourly, we can start to see a nice bolster in price action. And what looks like a chance here now that we built a similar base here to where we were at before and started to rip higher, I think that we're going to come back up here towards around 9,600. You get a close above this, I think it's very, very likely we get another kind of one of these rallies where we're just going to get a big bolt to the upside back above 10,000. And it'll be from there whether or not we can sustain that, as we'll likely be breaking out above the line of resistance. So again, that's the key thing here. To see us get above that line of resistance that we've talked about, I've got it on my Bitstamp chart just again to kind of hit home on it. All right, so we got the logarithmic chart. Yeah, it's going to take us above there like we did over here. It's about holding above there and possibly even rallying up to test that consistent line that we've seen in the past that's played as both resistance and support on Bitcoin's price. Would give us a good kind of resistance range. We come back down the line, have a nice correction, bounce a few times, and eventually start to formulate the uptrend, which would be very, very nice for the bulls. All right. So let's go ahead and talk about what's going on in the world of central banks, guys. I try to, there's been so much interesting things going on with DeFi and things just developing within the crypto space that we definitely have kind of steered away a little bit from the macro picture as of recent. And you guys know I'm a macro guy. I like talking about this stuff. Sometimes you got to repeat a few points, but I think that there's some interesting things going on here that aren't really getting talked about. So the key thing here to discuss is where we're at right now. So the Federal Reserve and other major central banks, this actually isn't even including the total assets increase in central banks. Yardeni Research that puts this piece together, they're awesome, they're fantastic. They have pretty much all the up-to-date information. They actually update this stuff every single weekday morning, so you can see this was on June 19th. But you can see here, the Federal Reserve, as well as the Bank of Japan, the People's Bank of China, and the ECB, which are the four that get aggregated into this actual document here, have increased their balance sheet by the equivalent of $5 trillion US. Now again, some of that's in their localized currency, but this is in dollarized terms. So $5 trillion, the largest increase by far in history. In fact, more than double of what the Federal Reserve did back here in 2008. So massive increase here. And again, after coming in from, kind of coming in just barely into neutral territory and just starting to enter into quantitative tightening, the market couldn't handle it. And of course, as well, we did obviously have a very shaky macro environment with kind of an event that I don't think anyone could have seen coming to the degree of, I think some of us kind of saw it a little bit ahead of time. But again, I think, thinking 2 or 3 months out before it really became news, right? These kind of black swan events or these events can really lead to these kind of shape-ups in markets where central banks have to respond promptly. Because what happened here over the last few months is everything shut down, is that you basically had a huge liquidity crunch back in March, right? And this is what happened to Bitcoin's price, why we had the massive sell-off back in March, as well as gold and silver, as well as equities. Everything was practically selling off, right? And this is the Fed stepping in and providing this liquidity. Now, this is not just relevant in the United States, and it's not just relevant for the Fed, right? It's relevant in two other ways across the world, because not only do other central banks have this issue with their local currencies and their local businesses and their economies, so they have to print euros, Japanese yen, Chinese yuan, in mass amounts, right? And this also goes for Australia and Canada and all the countries across the world. But it's also relevant in the sense of the Fed in the global picture as well, because the world depends on dollars. It's one of the big benefits that the United States has. It's something that I think we take a bit for granted sometimes. It's just how relevant dollars are across the world. And with this shortfall in the economy that happened as we freezed things, right, there was a key need for dollars, and there still is to this day, even as the Fed is continuing to inject capital. They're at a point here where they're trying to start to taper. They're trying to start to, kind of cut back the increase here of the balance sheet, the change on an annual basis to a slower pace. But the question is, are they really going to be able to do that? Well, again, there's been a theory that's been going around, and again, we're going to have a video later on this week that has Alex from Nuggets News, one of my good friends in the crypto space, one of the larger YouTube channels in the Australian ecosystem for cryptocurrencies. A good friend of mine, his first YouTuber I actually got to meet in person, who modifies a theory that's been titled the dollar milkshake theory. And it's created by an individual known as Brent Johnson of Santiago Capital. He's a fund manager. And basically, the whole idea is that the Federal Reserve is almost kind of like a milkshake. It's this milkshake of liquidity. And everyone across the world, as the world depends on dollars, is trying to plug in straws here in this case, right? To basically pull some of that liquidity out, to get some of that to relieve their economy and to keep things flowing. Because money or credit, whatever you want to call it, is what drives things. It's the circulating lifeblood of an economy, and it keeps the machine going, because that's what we live off. We live off a system of debt, right? And the thing is that, at the current moment, even though the Federal Reserve has created double of what it's created back in 2008, the kind of mass annual change of liquidity is double of what we had back then. Brent believes, alongside many other individuals, that it is not enough, that the Fed is in a catch-22. Right? Because if it pulls back the lever from where it's at right now, again, that's not only probably going to mean disaster for equity markets in the United States, the real world economy in the United States, but outside of that as well, it's going to mean global disaster for other economies. And as other dominoes across the world fall, it's going to be bad for the United States. There will be a sense of contagion, because less demand from other foreign buyers is going to mean less growth here in the United States. And just generally, less economic growth globally tends to have a hindrance on us. It's kind of the philosophy, right, of being a free market, everyone interacting with one another, building up the economy, right? So again, they're in this catch-22 where, again, if they continue to increase liquidity, right, again, they have to keep injecting capital into the system, right? They need to keep debasing the currency. They need to keep inflating equity markets in a sense, right? So anyways, this really interesting kind of situation that the Fed is in has proven to us to a degree that we probably know where the Fed is going to take this. I mean, you can see here, for example, this is the options market right now, pointing to the probability of negative interest rate policy in the UK and the US. Whereas for a long time, this was sitting at near 0% back in 2018. We are now above 40% and 50% respectively for the UK. What do you guys think this is going to go to eventually? I think it's going to go to 100%. I think anyone who's doubting that the Federal Reserve, or that, the Bank of England in the case of this chart, or the ECB, all these central banks who are already teetering on negative interest rates, that they're going to hesitate going down into negative interest rate territory. They have to. They have to. If they want to keep the system going and they don't want to have a hard reset, they're going to have to do this. We've talked about this as far back as 2019, and it looks like COVID was the trigger to cause it, right? Now, I know some people, I know people get angry when I would say something like that. Yes, it's not the reason why we need to go to negative interest rates. However, it was the black swan in a sense. It was the event that inevitably led us to seeing all the other dominoes that were set to fall. It was the trigger that really caused it. And again, negative interest rates are going to build a whole plethora of problems for the average everyday person. But that's not the only thing. For example, the Federal Reserve now is finally coming in and trying to cover itself because they apparently didn't know, even though there's a video of Jay Powell, years ago basically stating that, mass amounts of, quantitative easing, mass amounts of stimulus was going to lead to inequality. Now they're coming out and kind of playing it off as if they didn't know that this was going to happen, that this would further destroy the middle class, not only here in the US, but other economies across the world, and further widen the gap between people who are making a killing in asset markets. Could be us here in this case, guys. We're always keeping active in investing and watching the market, but also in increasing poverty. 40 million unemployed. Federal Reserve can bail out hedge funds, but it can't put a single paycheck in the hands of everyday people. No, see, the Federal Reserve expects that the government do this. They're passing on this obligation to the federal government. They're asking through mass amounts of bailouts that they go out and help people, and they bail out, provide economic relief in this case. And you'll see these are some of the things that Jay mentioned. For example, he believes that there should be boosted unemployment aid to jobless people. Along with this as well, that states should be getting more aid than they're getting right now, and that the government should continue funding efforts to suppress the coronavirus, right? All kind of surface level stuff, right? Again, I think that this all sounds good on paper, right? But why is it that the Federal Reserve, which has an infinite liquidity printing machine, why can't it buy up financial assets like it does from hedge funds who bought risky bonds, right? Let's be honest. They bought high yield bonds that were likely going to default. They picked that up and said, have at it, go gamble again. And they can't provide instant liquidity to everyday people. I just don't get it, right? There's not much sense to it, guys. But again, I think it proves it here, right? And again, the Fed is expecting here, the current environment, that unemployment is going to stay high. For any of you who are seeing positive estimates that we're going to, 8, 6, 5% unemployment in the next year, good luck. I'm sorry, guys, it's not happening. That's not me being a pessimist. I'm a pragmatic optimist at the end of the day. I like to see the optimistic side of things, and that's usually what wins out as an investor. But man, if you want a realistic picture of what's going to be happening over the next years, there's a lot of reprehensible damage that's not going to be fixed in the next couple of months. I can tell you that. We are going to be like the Federal Reserve states. I think as Jay Powell stated, we are going to have unemployment. I think they expected here, let me read just to make it sure it's right. I think it's around like 9% unemployment, well beyond 2020. In the first economic projection this year, the Federal Reserve officials indicated that they expected the unemployment rate to end in 2020 at 9.3% and remain elevated for years, coming in at 5.5% in 2022. I think that that's possibly doable, because that's 2 years out from now. But this is, again, you always have to factor as well the Federal Reserve's, not the Fed's, but really the Labor Department statistics on what's considered to be employed. I think we've already seen a pretty big loosening over the last few decades of what it means to be employed and what it means to be making a decent income, right? I guess that's not even a factor anymore about being employed. But I digress, right? Under the current standards, that's their estimations. And in that case, I don't think that's completely far out, maybe 2 or 3 years out. So again, just ditch all of the economic models you guys are seeing in this case, because whatever the Fed is saying is probably the most kind and, optimistic projection that there is right now. Because the Fed has to do this. They have to keep ponying up to the idea that their policies are helping the underlying economy. I'm sorry I get fired up about this, guys, but it's the same kind of habits that they constantly, they just can't give up on the system that they've built, right? It really is. It's a massive bubble of proportions we haven't seen. And this is why I truly believe, as we enter into negative interest rates over the next few months, as we continue to see the Fed printing massive amounts of money, and as the federal government, as we saw with previous recessions in the past, are going to enter into a secondary bailout. They're already talking about the HEROES Act, the $3.4 trillion of money that's going to be going towards social programs, it's going to be going towards state governments, it's going to be going towards financing all kinds of things, many of which I bet we probably wouldn't support if we knew what's in that bill. When all of this comes in, we're going to get our roaring 20s. We haven't even seen it yet. I really don't think we have seen it yet. Equity markets are already extremely overvalued. But what I think is going to happen here is you're going to see the biggest asset bubble in history. I think it's going to be similar to what we saw back in the 20s, where, again, there is an endless amount of printing. We constantly make the rules where people can be more leveraged up, take more risk. There is no reprehensive consequences for taking on that excessive risk. In fact, we encourage it. In a world of negative interest rates, you are encouraged to support and invest in things that are losing money. Think about that, right? If you think about it from a practical business standpoint, we're not even talking about asset markets. If I have a business that is losing 0.5% every year, right? I'm at break even. Maybe it's a startup or something, whatever it may be, or maybe it's a well-established company. I could be losing money, and because of the way I get credit, I can still be technically a profitable business. I can still keep afloat. It's a crazy world we live in, guys. And this is why we see the increase in zombie companies, the companies that can't even finance the interest on their debt, let alone pay down the entire debt that they've taken on, or a portion of it, principal. So how can you kind of prepare yourself in this environment, guys? Well, I think there's a lot of different ways you can go about it, but if you're not, again, no financial advice, you have to determine for yourself. In my opinion, and I speak it through my actions, if you're not exposed to assets, you are going to be dismantled by the Federal Reserve's monetary policy. I don't think this is the key thing that I always emphasize. It's worse off in other countries, like for example in Latin America, throughout Argentina and Brazil and Venezuela, and also in other areas of the world like Turkey, all the areas that are experiencing currency crises that we've been talking about since 2018. Yes, that's the dire case scenario. But don't think that we are immune to that reality, that it can't happen in our own streets here in the US or in Europe or in other areas where it's not so severe, because it can. And there are very few assets that are they're actually going to be able to hedge in this environment, that actually have the growth potential to multiply in this environment. Equities, yeah, they'll probably go up, but by how much? How much liquidity do you have to put in the system to keep a $50 to $100 trillion market? I mean, if you're talking about U.S. equities or the broader equity market, how much liquidity do you have to inject to double that? It's markets of scale, guys. It's the key thing to keep in mind when you make any investment. I understand it's important to, maybe see in the short term if there are opportunities in other markets, or, for example, if it's a good time to get into cash. And sometimes you feel like trading and kind of, doing all these things in the short term. It can be a bit nerve-wracking sometimes. But think about the picture for the next 2 or 3 years. Okay? Equities, $50, $100 trillion market. Chances of that doubling in the next year, no matter how much the Fed prints, very unlikely. We haven't seen in a single year or two that the stock market double in valuation in decades in the United States. But Bitcoin is a $173 billion asset. The broader market of cryptocurrencies, you can probably exclude some of the valuation, some of it's artificial. Roughly speaking, a little bit above $250 billion. Bitcoin needs to go to $340 billion to double. That's it. If you consider the equity market cap, along with gold, which is $10 trillion, roughly speaking, Bitcoin is a small speck on the map. And even if it were to double, it'd still remain a small speck. It needs multiples upon multiples to get anywhere close to where gold or equities or the broader property market or the bond market, it's so minuscule. It's an evolving asset. And as many people would shy away from Bitcoin because of that reason, that's the exact reason I buy into Bitcoin. It's the same reason I'm long cryptocurrencies more out of any other market, because as a macro trader, I look for multiples. I look where the next thing is going to be, and I park my capital there, and I wait. So anyways, rambled on enough. For those of you who are curious, the Fed is on pace for doing exactly what I think we all know they're going to do. They're going to use every single tool. As Jay Powell has said himself, as well as other Fed chairmen in the past, they will use every tool at their disposal. As Neil Kashkari of the Federal Reserve said, they have infinite money. So where are you going to position yourself? in that time of infinite liquidity. I'm curious to hear down below in the comments, guys, what you're interested in, what you're keeping your eyes on right now. But that all being realized, thank you all for listening to me ramble a bit today. I know it's a hard topic and stuff, but there's it's changing times, and we gotta get ready for it. So I hope you guys are doing well. It was nice getting to talk to you guys today, and I'll see you all in the next video. Have a great start to your Monday, and I'll see you all in the next one.